Property tax increases are hitting homeowners hard nationwide. Despite the already unaffordable housing crisis, states are requiring homeowners to pay even more in property taxes as they need more tax revenue. This is why some say you never actually own your home.
The government, they can take everything away from you, because if you have a house, they can increase property taxes until you can't afford to live in your own house.
It's happening now.
Yes, it's happening now.
Before we get started here, I'm Todd Sachs. I'm a real estate broker in Maryland, and my job is to help home buyers and sellers navigate the housing market. I am not a tax consultant, attorney, or real estate appraiser, so take the information you're about to hear as my professional opinion only and verify all information for yourself. Now, property taxes are on the rise. And according to a redfin.com article posted in October of 2024, this article states that property tax bills have increased since 2019 in nearly every major U.S. metro, with Florida home to 3 of the 5 metros with the biggest hikes. Now, according to the Redfin article, if you live in Indianapolis, Indiana, the median tax bill increased 66.7% since 2019. That is nearly double. And in Atlanta, Georgia, median tax bill increased 65.8%, again, nearly doubling. And if you live in Jacksonville, Florida, your bill increased 59.6%, Tampa 56.7%, and Miami, Florida went up 48.1%. And in my state of Maryland, property tax assessments rise for 7th straight year. And on this WTOP.com article, Maryland Department of Assessments and Taxation reports residential real estate property taxes are up by about 20% from 3 years ago. For 7 consecutive years, all 23 counties and the city of Baltimore experienced an increase in property value assessments. Now, this is one of the reasons why I am constantly warning people to be careful when buying a home. Do not max out your monthly payment budget. And what I mean by this is, if you obtain a 30-year fixed rate mortgage, your monthly mortgage payment amount will be the same for the entire 30 years. Every month as you pay your mortgage, you're paying down the principal, which means the actual mortgage balance. And you're also paying your lender the interest payment. Now, when you first finance your home, the bulk of your mortgage payment for like the first 19 years or so, most of your payment goes towards that interest payment. So, for example, let's look at this mortgage amortization schedule. So I've put the link to this amortization calculator in the show notes below, as well as all the other links to the sightings. But here we're looking at if you had a $400,000 loan balance for 30 years at an interest rate of about 6.25%, and we're starting that loan in January of 25. So what I did here is I clicked on schedule because I wanted to see everything, over time, what we're paying in principal towards the balance in our payment and what we're paying towards the interest payment, which goes to the lender. And what I did is I expanded all of the years. So just real quickly, when we're looking at this, so we started the loan in January. The first payment is due February 1st. And by the way, here's your payment, $2,463. Principal and interest does not include taxes or insurance or homeowner association fees or condo fees or anything like that. So basically, if we look in February, our first payment of that $2,463 payment, $379.54 goes towards your balance, and $2,083.33 goes towards your lender, making them rich. But what I really want to get at is, as we go through this amortization schedule through the years, it took 19 years. We're at the year 2044 before your loan payment, actually half of it right here goes to the principal balance and half of it still going to your lender. So 19 years it takes in order to start balancing out where your payment is making a massive impact in your mortgage balance. So when people only stay in their home for, let's say, 7 years or so, the bulk of their payments they paid to buy their home went mostly to the lender. The same goes when people refinance their home mortgage. Let's say you refinance because mortgage interest rates dropped, or you decide to refinance your mortgage because you want to cash out on your home's equity, should there be any, in order to pay higher revolving, let's say, credit card bills, for instance. Or maybe you want to buy something that you don't need, but you refinance. The amortization schedule that I just showed you actually starts all over again, back to day one, where the bulk of what you're paying is finance charges. Plus, refinance is expensive. It's loaded with fees, and you really need to crunch the numbers on how long you might stay in the home after refinancing to determine the cost, to see if the refinance makes sense. Despite your friend, the lender, telling you, hey, rates dropped, you should refinance, a mortgage can actually be a debt trap, folks. So buy a home that you can afford and sock down more money on the principal each month, so you pay less to the lender in interest rates and interest rate fees, and you get your mortgage paid off sooner than later. Now let's get back to property taxes. So if you have a residential mortgage, your servicer, the one that you pay your mortgage payment to, will collect additional money from you every single month to pay two things: your property insurance and your property tax bills when they are due. So they collect this extra money. It goes into what is called an escrow account. And this is about the time of year when we start getting a lot of calls, and they're going, Todd, my payment has gone up. My servicer, my loan servicer, is sending me something saying that my escrow is short, and that I could either pay the difference in a lump sum, or my new payment will be X amount of dollars to handle the increase in those bills, the insurance and property taxes. And the reason that the servicer is collecting this is because these two bills, they don't want to trust you to pay on your own, okay? And there's reasons for that. Firstly, if, let's say, you don't pay your homeowners insurance, the reason they're collecting this and making sure it gets paid is if you don't pay your homeowner's insurance bill, and let's say, God forbid, you have a fire and your house burns down to the ground, complete loss, your lender would be screwed, okay, because you didn't pay your insurance bill. So they're going to pay that insurance bill to make sure that the lender is covered for the amount of mortgage that you owe them. And the other thing they're going to do is, by collecting that tax bill, is they're going to guarantee that that tax bill is paid, your property tax bill, to your municipality, your government, your county, or your city. Because if you don't pay your tax bill, the government will actually come in and take your home from you through a foreclosure auction, or they put a lien on it at the very least, and kind of lock that down. They're going to get their money, the property tax money. Well, what happens is they actually move into the first position. So you have this mortgage, let's say, for $400,000, but you got this unpaid tax bill for $6,700. That unpaid tax bill takes precedence on your property lien because the government always gets their money. So the servicer for the lender that's collecting your money is going to make sure your property insurance gets paid and that your property tax bill gets paid, so that their assets, their mortgage, is protected. So in the U.S., if you don't pay your property taxes, so let's say you stop paying your mortgage, or you don't have a mortgage and you stop paying your property taxes, your state may allow the city or county to foreclose on your property. So what this means is the government does not need permission to take your home, to foreclose on your home. They don't need permission from your lender, even though you have a mortgage. And typically the lender has a lot more at stake, like I had described, than the government. But if you stop making your monthly mortgage payments, let's talk about this scenario for a minute. Let's say you stop paying your mortgage altogether, right? And I'm not telling you to do that, but let's say you stop paying your mortgage. You're going into foreclosure. Those two bills, your servicer is going to continue to pay out of their pocket, one to pay your property insurance, one to pay your tax bill. They're going to continue to pay that in perpetuity until they ultimately foreclose on your home, the lender, and take your home and then resell it to somebody, should you not ever get current on your mortgage. So people, I am not telling you to stop paying your mortgage. I'm just telling you that those two bills, property taxes And in property insurance, your lender or servicer will continue to pay on your behalf, even though you're defaulting on your mortgage. Now, as far as the states allowing your property to be sold for unpaid property taxes, I want to show you this Kiplinger.com article from May 30th of 2023. Not that long ago, prior to a 2023 Supreme Court ruling, many states could actually take all of your home's equity if they foreclosed on you due to unpaid property taxes. In this article, Who Benefits from the Supreme Court Home Equity Theft Ruling? The U.S. Supreme Court ruled that home equity theft violates the Constitution. What does that mean for homeowners? It all started when a 94-year-old woman who lost her home and her home equity due to past due property taxes. In the case Tyler versus Hennepin County, a unanimous court ruled that it's unconstitutional for a state to take your home to cover your property tax bill while pocketing the profit from your surplus home equity. So what does this all mean? So let's say you're in one of these states that allowed, prior to this 2023 ruling, these states that were allowed to just steal all of your home equity, no matter what they were owed for back taxes. I'll give you an example here. Let's say you owe $7,000 in back taxes and they foreclose on you, and your home is sold at auction for $60,000, let's just say. This state, prior to this 2023 ruling, could keep all of the $60,000. The fact that they were owed $7,000, maybe in back taxes, penalties, and interest, that $53,000 they pocketed, instead of turning that back over to you saying, hey, we sold your house for $60,000, we foreclosed on you. The state kept all of that money. The article says that since more than a dozen states allow what some call home equity theft, the court's ruling will impact homeowners across the country. Writing for the court, Chief Justice John Roberts pointed to history and precedent, saying that while the county had the power to sell Tyler's home to recover the unpaid property taxes, it could not use that tax debt to confiscate more property than what was due. Property taxes and home equity theft. This legal challenge began with property taxes, a fact of life for millions of U.S. homeowners. Now, if you don't pay the property tax due on your home, you could ultimately risk losing your property. In this case, Geraldine Tyler owed $15,000 in property taxes on her Minnesota condo, which she had lived in for more than 10 years before moving into a senior assisted living community. After failing to collect the property tax debt from Tyler, Hennepin County, Minnesota, sold Tyler's home at auction for $40,000. But rather than returning the remaining $25,000 to Tyler, the county kept the surplus home equity. Tyler sued, arguing that retaining the surplus from the sale of her home violated the Fifth Amendment of the U.S. Constitution, and it was also an unconstitutionally excessive fine. So this ruling will likely force certain states and localities to change their retention approaches or potentially face litigation and liability. The Pacific Legal Foundation cites data showing that U.S. homeowners lost more than $860 million in life savings on more than 8,950 homes. Which states retain home equity? States that currently retain the surplus equity in your home are Arizona, Oregon, Colorado, South Dakota, Minnesota, Nebraska, Illinois, Alabama, New York, New Jersey, Maine, and Massachusetts. The practice is also allowed in the District of Columbia. According to Pacific Legal Foundation, states that allow home equity theft in certain situations include Montana, Idaho, Nevada, California, Alaska, Texas, Wisconsin, Ohio, and Rhode Island. Counties and cities around the country know that property values have skyrocketed, and this in itself allows them to reassess property values, ultimately raising the amount you'll owe each year for property taxes. So as an owner-occupant, meaning that you live in the home, you're not a tenant, most people can take advantage of what's called a homestead exemption. But at its core, according to the National Association of Realtors, Homestead exemption reduces the taxable value of a homeowner's primary residence, meaning a portion of the home value will not be taxed. This reduction results in lower property tax bills. Available exemption amounts can depend on your age, disability, marital status, dependent children living at home, and property type. Homestead exemption laws protect the homeowner and their family from paying property tax. So if you're listening to this, make a note to see what your state offers and determine if you're taking advantage of what could ultimately reduce your property tax bill, making your homeownership more affordable. So right about now, many are receiving their new property tax assessments in the mail. If you disagree with the assessment, fight it. Just go to Google and search for the process to fight your state property assessment. So in Maryland, datmaryland.gov, this site says, while we strive to provide the most accurate assessments possible, customers sometimes feel that the department's estimate of their property value is incorrect. The assessment appeal process allows property owners the opportunity to dispute the value determined by the department. Property values rise and fall to reflect the market. Customers should file an appeal when the estimated value of their property does not accurately reflect what they believe is its current market value. In Maryland, there's 3 potential appeals. So your first step in action would be a supervisor's level appeal. And if you're not happy with that, administrative type of result, you can appeal it to the Property Tax Assessment Appeal Board. And if they come back and you're not happy with their decision, the appeal board's decision, you have a third appeal to the Maryland Tax Court. And in any case, I'm pretty sure the burden falls on you, the homeowner, to show that the property assessor made a mistake in valuing your property. So you'll need to be prepared with things like comparable sales, in your subdivision, to show them, hey, you know what? They made a mistake. This is what the property values are. This is what the sales are. And this is what I feel that, my property is worth. So love you guys. Thanks for watching. And don't forget, subscribe, comment, and please, please, please share this video and our channel with your family and friends. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.